Samantha is 31 years old. She has always been responsible with money. She pays her bills on time. She has never missed a payment in her life. Last month, Samantha bought a new couch and a dining table. The total was $2,300. She put it on her credit card. Samantha had the cash in her bank account. She was not going into debt. She just wanted the credit card points. 2 weeks later, the bill arrived. The moment it hit her inbox, Samantha paid the full balance. Every penny. Zero interest. She felt good. She did everything right. 3 days later, her phone buzzed. An alert from her credit monitoring app. Your credit score has decreased by 27 points. Samantha stared at her phone. She felt sick. She did not miss a payment. She did not apply for new credit. She did not do anything wrong. So why did her score drop? Here is the answer that most people never learn. Samantha paid her bill on time, but she paid it too late. Not too late to avoid interest. Too late to control what the credit bureaus saw. Samantha fell into a trap that catches millions of responsible people every single month, and it is all because of one specific date that nobody ever explains. My name is Kevin, and today I am going to show you the secret calendar of credit scores. I am going to explain why paying your bill in full does not mean your score stays high, and I am going to teach you how moving your payment by just 2 or 3 days can be the difference between a good credit score and an excellent one. This is the fastest way to improve your credit score. Faster than building payment history. Faster than waiting for old marks to fall off. This method works within 30 days. If you want to understand how the credit system actually works, subscribe and hit the like button. Let us decode this together. Most people know one important date on their credit card: the due date. The due date is the day you must pay your bill to avoid late fees and interest. If your due date is the 25th, and you pay on the 25th, you are safe. No penalties. No extra charges. This is the date that everyone focuses on. Banks put it in big bold letters on your statement. Apps send you reminders about it. Everything in the credit card system screams pay by this date, and that is exactly the problem. There is another date that matters more for your credit score. Almost nobody talks about it. Banks do not highlight it. Apps do not send reminders about it. It is called the statement closing date. Let me explain what this is. Every credit card has a billing cycle. This is usually about 30 days. Let us say your billing cycle runs from the 1st to the 30th of each month. During those 30 days, you use your card. You buy groceries. You pay for gas. You order things online. Your balance grows. On the 30th, the cycle ends. The bank creates your statement. This is the PDF bill that shows up in your email or mailbox. Here is the critical part that nobody explains. The balance on your statement closing date is the balance the bank reports to the credit bureaus, not your balance on the due date, not your balance after you pay. The balance on the day the statement is created. Your due date might be 3 weeks later. But by then, the credit bureaus already have last month's snapshot. Let me show you how this traps people like Samantha. Imagine your credit report as a photograph album. Every month, someone takes a picture of your finances and puts it in the album. But here is the problem. They do not take the picture when your room is clean. They take it when your room is messy, right before you clean up. Let me walk through Samantha's timeline. Samantha's billing cycle ran from March 1st to March 30th. On March 15th, she bought the furniture. $2,300. Her credit limit is $5,000. On March 30th, the billing cycle closed. The bank generated her statement. Her balance on that day was $2,300. That balance, $2,300 out of $5,000, was reported to Experian, TransUnion, and Equifax. Her due date was April 20th. Samantha paid the full balance on April 18th, 2 days early. Perfect, but it did not matter. The credit bureaus already had the March 30th snapshot. They saw that Samantha was using 46% of her credit limit. To the algorithm, Samantha looked like someone who uses almost half her available credit. That triggered a score drop. Samantha felt responsible because her bank account showed money leaving to pay the bill. But her credit report looked like she was maxing out her cards. This is the snapshot trap. You are living in real time. Your credit score is living on a 30-day delay based on a photograph taken before you made your payment. Now you might be thinking, okay, my reported balance was high for 1 month. So what? It is just a few points. Let me show you why utilization is one of the most powerful factors in your credit score. The FICO score, which is used for most major lending decisions, is calculated from 5 categories. Payment history, 35%. Did you pay your bills on time? Amounts owed. 30% how much of your available credit are you using? Length of credit history. 15% how long have you had credit? Credit mix. 10% do you have different types of credit? New credit. 10% have you applied for new credit recently? Look at that second category. Amounts owed. 30% of your entire credit score. That is almost 1/3 of your financial reputation based on how much credit you are currently using. This is measured by something called the credit utilization ratio. The math is simple. Take your current balance, divide it by your credit limit. That is your utilization percentage. If you owe $1,000 on a card with a $5,000 limit, your utilization is 20%. If you owe $4,000 on that same card, your utilization is 80%. And here is what the algorithm thinks about different utilization levels. 0%. The algorithm gets confused. We will talk about this later. 1 to 9%. Excellent. This is where the highest scores live. 10 to 29%. Good. Your score is stable. 30 to 49%. Warning zone. Your score starts dropping. 52, 74%. Danger zone. Significant score impact. 75 to 100%. Emergency. Your score can tank by 50 points or more. Samantha was at 46%. She crossed into the warning zone and her score responded immediately. John Alzheimer, one of the country's leading credit experts, has studied this extensively. He explains that crossing the 30% threshold is like triggering an alarm in the scoring model. The algorithm sees high utilization as a sign of financial stress. Historically, people who use most of their available credit are more likely to default on their debts. So the score adjusts to reflect that risk. But here's the amazing thing about utilization. Unlike missed payments, which haunt your report for 7 years, utilization has no memory. Let me tell you about a man named Brandon. Brandon made a mistake. He went on vacation and charged almost everything to his credit card. When the statement closed, he was at 89% utilization. His credit score dropped from 782 to 714, a 68-point drop. Brandon panicked. He thought he had ruined his credit for years. But here's what actually happened. Brandon paid off the card completely. The next month, his statement showed a balance of just $14, 1% utilization. When the new statement was reported to the credit bureaus, Brandon's score jumped back up. Within 30 days, he was at 775, not quite where he started, but very close. Utilization is what credit experts call memoryless. The scoring model does not remember last month's utilization. It only sees the current snapshot. If you were at 90% last month and you pay it down to 5% this month, your score rebounds as if the 90% never happened. This is completely different from a missed payment, which stays on your report for 7 years. This is why the statement date strategy is so powerful. You are not fixing a permanent scar. You are just correcting the current photograph. You can fix a utilization problem in 30 days or less. So how do you control the snapshot? The answer is simple. You pay your balance before the statement closes, not after. Let me walk through the exact process. Step 1. Find your statement closing date. This is not the same as your due date. Your due date is usually about 3 weeks after the statement closes. To find your statement closing date, you need to look at an actual statement from your credit card. Open the PDF. Look for words like billing cycle ends, or statement closing date, or next statement date. Write this date down. Put it in your calendar. Step 2. Set a reminder. Set a reminder for 2 to 3 days before your statement closing date. Why 2 to 3 days? Because payments can take time to process. You want the payment to clear and post to your account before the statement is generated. If your statement closes on the 15th, set a reminder for the 12th or 13th. Step 3. Pay down your balance. On your reminder day, log into your credit card account. Look at your current balance. If you want your reported balance to be low, you need to pay most of it now. Let us say your balance is $1,500 and your credit limit is $5,000. That is 30% utilization. To get below 10%, you need your balance to be under $500, so you pay $1,100 right now. Your balance drops to $400. That is 8% utilization. Step 4. Let the statement close 2 days later. The statement closes. The bank generates your bill, showing a $400 balance. That is the number reported to the credit bureaus. Your credit report shows 8% utilization instead of 30%. Step 5. Pay the rest after the statement closes. You still have about 3 weeks until the due date. Pay the remaining $400 before the due date. You pay 0 interest. You used the card normally. You spent $1,500, but the credit bureaus only saw $400. You controlled the snapshot. Now you might be thinking, if low is good, 0 must be best. I will just pay my card to 0 before every statement closes. Stop right there. This is one of the most common mistakes people make, and it is based on a myth that feels true, but is not. Let me tell you about a woman named Kristen. Kristen was obsessed with having 0 balance. She paid her credit cards every week, sometimes multiple times per week. She made sure her statement always showed exactly $0 owed. Kristen was proud of this. She thought she was being the most responsible borrower possible, but Kristen's credit score was stuck at 752. She could not break 760, no matter what she did. One day, Kristen learned the truth. Reporting 0 balance every single month can actually hurt your score. Here is why. The credit scoring model is designed to assess how you manage debt. If your report shows $0 owed month after month, year after year, the model has no data about how you handle repayment. In the eyes of the algorithm, a person who does not use credit is slightly riskier than a person who uses it responsibly. You are not demonstrating the behavior they want to score. You are a ghost. Research from MyFisio, the consumer division of FICO, shows that people with the highest credit scores, those with 850, do not have 0% utilization. They averaged between 4% and 7% utilization. They use credit, but they use very little of it. The sweet spot is 1 to 9% utilization. This shows activity without risk. There is a specific strategy for maximizing your credit score. Credit experts call it a ZEO. It stands for all 0 except 1. Here is how it works. If you have multiple credit cards, you pay all of them down to 0 before their statement closing dates, except one. For that one card, you leave a small balance, maybe $10, maybe $20, just 1 or 2% of the credit limit. This tells the algorithm, yes, I am using credit, but I am keeping it extremely low. Let me show you an example with a man named Tyler. Tyler has 4 credit cards. Card A, $5,000 limit. Card B, $3,000 limit. Card C, $10,000 limit. Card D, $2,000 limit. Total available credit, $20,000. Tyler uses all 4 cards during the month. But before each statement closes, Card A, paid 20. Card B, paid 20. Card C, paid 20. Card D, paid down to $20, 1% of limit when the statements close and get reported to the bureaus. Total balance reported, $20. Total available credit, $20,000. Overall utilization, 0.1%. Tyler is showing activity on 1 card, while maintaining near 0 utilization overall. His score jumped from 768 to 791 within 2 months of starting this strategy. Now, here's the important clarification that trips people up. Reporting a balance is not the same as carrying a balance. Tyler's statement shows a $20 balance, but he pays that $20 before the due date. He pays 0 interest. He is threading the needle between the reporting date and the due date. The balance gets reported to the bureaus good for his score. Then he pays it off good for avoiding interest. Let me address the fear that stops people from trying this strategy. If I leave a balance on my statement, will I pay interest? No. Not if you pay by the due date. Here is how credit card interest works. Most credit cards have something called a grace period. This is the time between when your statement closes and when your payment is due, usually about 21 to 25 days. As long as you pay your full statement balance during the grace period, you pay 0 interest. Let me walk through the timeline again. Statement closes on June 15th. Your balance is $50. Due date is July 8th. You have 23 days. You pay the $50 on July 5th. Interest charged, $0. You got the credit score benefit of showing a small balance. You paid nothing extra. The key is paying the statement balance by the due date. The grace period protects you. However, there is one situation where this does not work. If you are already carrying a balance from a previous month and paying interest, the grace period disappears. In that case, you need to pay your card to 0 and keep it there for a full billing cycle to restore the grace period. There is another layer to utilization that many people miss. The scoring model looks at 2 types of utilization. Overall utilization, your total balance across all cards, divided by your total credit limit across all cards. Per card utilization, the balance on each individual card, divided by that card's limit. Both matter, And the Picard calculation can hurt you even if your overall utilization is low. Let me tell you about a woman named Rebecca. Rebecca has 3 credit cards. Card A, $20,000 limit. Zero balance. Card B, $15,000 limit. Zero balance. Card C, $1,000 limit. $900 balance. Overall, $900 owed on $36,000 in total credit. That is only 2.5% overall utilization. But card C has 90% utilization on that individual card. Rebecca's score was lower than she expected because the algorithm flagged that one maxed out card. Even though her overall utilization was excellent, having one card near its limit looks like a sign of distress. The lesson: spread your spending across cards, or pay down individual cards before they get too high. A good rule is to keep each individual card below 30% utilization, even if your overall utilization is fine. Before you rush off to pay your cards multiple times per month, I need to give you a serious warning. There is a practice called credit cycling that can get your accounts closed. Let me explain what it is. Imagine you have a credit card with a $2,000 limit. In 1 month, you spend $2,000. You pay it off, then you spend another $2,000. You pay it off again, then you spend another $2,000. Total spending that month, $6,000. But your limit is only $2,000. You might think the bank loves you for this. You are spending a lot and paying it all back. You would be wrong. To the bank's fraud and risk department, this looks suspicious. It looks like money laundering or bust-out fraud. Credit cycling is when you repeatedly pay off your balance to artificially extend your spending beyond your credit limit. Banks gave you a specific limit for a reason. That is how much risk they want to take on you. When you cycle through that limit multiple times, you are forcing them to take on more transaction risk than they agreed to. This can trigger a financial review where they freeze your account, a request for tax returns and income verification, a reduction in your credit limit, account closure. To avoid looking like a risk, keep your monthly spending roughly within your credit limit. If you find yourself constantly hitting your limit and needing to pay it down just to keep using the card, you do not need a payment hack. You need a credit limit increase. Call your card issuer. Explain that you pay in full every month and you need more room for daily expenses. Many issuers will increase your limit with a simple phone call. Here is another common mistake that destroys credit scores. People sometimes close old credit cards they are not using. They think they are simplifying their finances. In terms of utilization, this is a disaster. Let me show you why with a man named Austin. Austin has 3 credit cards. Card A, $10,000 limit. $500 balance. Card B, $5,000 limit. Zero balance. Old card, he never uses. Card C, $5,000 limit. Zero balance. Another old card. Total available credit, $20,000. Total balance, $500. Overall utilization, 2.5%. Austin decides to close Card B and Card C. He does not use them anyway. Now his numbers look like this. Total available credit, $10,000. Total balance, $500. Overall utilization, 5%. His utilization doubled just by closing cards. But that is not the worst case. Imagine Austin had a higher balance. If he owed $3,000 on Card A before closing cards, 3,000 out of 20,000 equals 15%. After closing cards, 3,000 out of 10,000, 30%. He went from excellent utilization to warning zone utilization without spending a single extra dollar. The fix is simple. Keep old cards open. If you are worried about annual fees, call and ask for a no-fee card instead of closing the account. If you are worried about fraud, put one small recurring charge on the card, like a streaming service, and set it to autopay. This keeps the account active without you having to think about it. Old cards are ballast. They keep your utilization numbers healthy. I want to be honest about something. The strategy I have described works perfectly for FICO 8, which is the most commonly used scoring model for mortgages, auto loans, and credit cards. But newer models are getting smarter. FICO 10T and VantageScore 4.0 use something called trended data. Instead of looking at a single snapshot, they look at your balance history over the past 24 months. With trended data, the algorithm can see patterns. Are you someone who pays in full every month? Are you someone whose balance keeps growing? Are you someone who makes minimum payments and carries debt? If you historically run up huge balances and only pay them down at the last second, trended models might notice that pattern. However, here's the reality for now. Most lenders still use FICO 8, the snapshot model. According to FICO's own reports, FICO 8 remains the dominant model for mortgage lending, auto lending, and credit card approvals. FICO 10T adoption is growing slowly, but it is not the majority yet. For the foreseeable future, the statement date strategy remains the fastest and most effective way to optimize your credit score. Let me give you the complete step-by-step protocol for maximizing your credit score through utilization. Step 1. Gather information. Find the statement closing date for every credit card you own. This is in your statements, not in the app alerts. Write these dates on a calendar. Step 2. Set reminders for each card. Set a reminder 2 to 3 days before the statement closing date. Step 3. Do the math on your reminder day. Log into each account. Look at the current balance. Calculate your utilization, balance divided by credit limit. If it is above 10%, you need to pay it down. Step 4. Pay strategically. Pay most of your balance before the statement closes. If you are doing the AZIO method, pay all cards to 0, except one. Leave one card with a small balance of 1 to 3%. If you are keeping it simple, just pay every card down below 10% of its limit. Step 5. Let statements close. The statements will close with low balances. Those low balances get reported to the bureaus. Step 6. Pay the rest after statements close. You still have about 3 weeks until the due date. Pay any remaining balance before the due date to avoid interest. Step 7. Repeat monthly. This is not a one-time fix. Do this every month, especially if you know you are applying for a loan soon. Do you need to do this every single month? Not necessarily. If you are just living your life and not applying for any loans, keeping your utilization generally below 20% is usually good enough. Set autopay and do not stress about it. But there are times when you want to be aggressive about utilization. Applying for a mortgage. This is the biggest loan most people ever take. Every point matters. Use the AZIO method for 2 to 3 months before applying. Applying for an auto loan. Same logic. Get your score as high as possible before the application. Applying for a credit card. A higher score means better approval odds and higher limits. Refinancing existing debt. Better score means better interest rates. In these situations, the 30 to 60 points you might gain from utilization optimization can translate into thousands of dollars in savings over the life of a loan. A 2024 study from LendingTree found that the difference between a 760 credit score and a 700 credit score on a 30-year mortgage can mean over $50,000 in extra interest payments over the life of the loan. Utilization optimization costs you nothing but pays back thousands. I want to end with something that goes beyond the numbers. Many people have a fear of credit cards. They have heard horror stories about debt. They have seen friends or family members destroyed by credit card interest, so they avoid credit cards entirely. Or they pay them off obsessively, sometimes multiple times per week. Both approaches come from fear. And while the caution is understandable, it can actually hurt your credit score. The credit scoring system is designed to reward people who use credit responsibly. Using a small amount of credit and paying it off on time is exactly what the model wants to see. If you never use credit, the model has no data on you. You are an unknown. The sweet spot is using credit, but using it lightly. Think of it like a gym membership. The healthiest person is not someone who never goes to the gym. And the healthiest person is not someone who goes for 8 hours every day. The healthiest person is someone who goes regularly, but moderately. Credit works the same way. Regular, moderate use. Pay it off. Repeat. Dave Ramsey, who is famously anti-debt, would probably disagree with this philosophy. He believes in avoiding credit cards entirely. But if you want to build a high credit score within the current system, you need to play the game. And playing the game means understanding utilization. Ramit Sethi addresses this directly in I Will Teach You to Be Rich. He explains that credit cards are tools. Like any tool, they can hurt you if misused. But when used correctly, they provide benefits, rewards, purchase protection, and most importantly, a strong credit score. The key is automation and awareness. Set up systems so you never miss a payment. Understand the statement date so you control what gets reported. Master the system instead of fearing it. Let me finish with Samantha's story. Remember her. She bought furniture, paid her bill on time, and watched her score drop 27 points. Samantha was frustrated and confused. She almost swore off credit cards entirely. Then she learned about the statement closing date. The next month, Samantha tried the new strategy. She looked at her statement closing date. She paid her balance down 3 days before it closed. She left a balance of $15, about 1% of her limit. The statement closed, showing a $15 balance. That was reported to the bureaus. 3 weeks later, she paid the $15. 0 interest. When her next credit score update came through, Samantha's score had jumped 31 points, higher than before the furniture purchase. Samantha did not change how she spent money. She just changed when she paid. 2 days made a 31-point difference. That is the power of understanding the system. You are not a victim of the algorithm. You are the manager of it. Take control of the snapshot. Thank you for watching. If this video helped you understand credit utilization, please share it with someone who needs to see it. Subscribe for more videos about mastering money and building wealth the smart way. Try this strategy for 1 month. Pay your card down before the statement closes. Watch your score, and come back to tell me how many points you gained. I will see you in the next one.